From the company perspective, stock markets provide access to capital, usually in the form of cash. If a company needs to finance a major project, it can sell its shares in the stock market to raise capital instead of borrowing the money from a bank. From the shareholder perspective, the stock market provides a way to participate in a company's growth and also quickly convert shares into cash. This happens in two main ways. In a privately held company, stockholders are usually comprised of founders and initial investors who can sell their shares on the stock market exchange and reap the reward for the risk they took in creating and growing their business venture. This is referred to as the primary market. For investors who own shares in publicly traded companies, the stock market allows them to participate in the growth of a company without taking the risk of starting a company themselves. This is referred to as the secondary market. The two main stock markets in the United States are the New York Stock Exchange, NYSE, and the NASDAQ. Foreign stock exchanges include London Stock Exchange, Hong Kong Stock Exchange, Euronext, and Deutsche Börse. In the early days of the stock markets, stocks were traded on the floor of the exchange person to person. Now almost all stock trades are done electronically.
So, what is a stock market? Um, it's important that we understand that we're not just buying stocks. We're in a sense of buying businesses. We are investors. So it's all about asset ownership. We want to continue to own assets, own businesses long term, and we want to make money off of that business. So a company, a business would be able to provide, shares of stock, certificates of stock to the public so that they can raise cash, for their business, right? So, if they're issuing a stock at $100 a share, I would be able to, and you'll be able to buy a share of that company, an ownership share of that company for $100.